Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Alarm.com Holdings Inc. Annual Report. Alarm.com Holdings Inc. offers a wide range of businesses and services that cater to various markets, including residential, multifamily, small business, and enterprise commercial sectors. The company's solutions include security systems control and monitoring, IoT device management, video analytics, AI deterrence, and smart home automation. Some of the key services provided by Alarm.com include security system control and monitoring, video analytics and AI-powered enhancements, smart home automation, including door locks, garage doors, thermostats, and video cameras, energy usage monitoring and energy saving solutions, commercial-grade video, and commercial video analytics, access control and cell connectors, enterprise dashboard and multi-site management, connected fleet and daily safeguard solutions. Alarm.com also offers a range of additional services, including installation and support services, mobile tech application and remote toolkit, video health reports, and smart gateway sales, marketing, and training services, home builder programs, electric utility grid and water management solutions, indoor gunshot detection, and health and wellness solutions. The company has a strategic partnership with Everin, LLC to deliver unified console solutions for integrated intrusion protection, access control, remote video monitoring, and business management. With its extensive range of businesses and services, Alarm.com Holdings, Inc. is well-positioned to meet the needs of various markets and customers. Alarm.com Holdings, Inc.'s stock price has experienced a significant downturn over the past year, with drops ranging from -25.4% to -27.33%. While various factors may have contributed to this decline, several key events stand out as potential causes. One notable event was the downgrade by J.P. Morgan Chase & Co. in February 2026, which lowered Alarm.com's price target from $55 to $40 and issued an underweight rating. This move was followed by similar adjustments from other analyst firms, including Zacks Research, Weiss Ratings, and Barclays. Additionally, the company's recent financial results for the fourth quarter and full year 2025 showed a decline in stock price despite increases in SaaS and license revenue, total revenue, and GAAP net income. Furthermore, insider selling was reported in December 2025, with directors and insiders selling shares at prices higher than the stock's 52-week low. The combination of these events may have contributed to Alarm.com's significant decline in stock price over the past year. However, it is essential to note that the specific news event directly causing a single drop of over -25.36% is not explicitly detailed in the provided information. Alarm.com Holdings, Inc. maintains a market capitalization of $2 billion, broadly in line with the industry peer group. Alarm.com Holdings, Inc. trades at a higher price-to-earnings ratio of 19 times and a higher price-to-book ratio of 2.72 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 62% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified by examining the provided extract. On one hand, SaaS and license revenue experienced a significant growth of 15.6% year-over-year, contributing to the overall total revenue growth of 4.8%. This growth was primarily driven by the Alarm.com segment, which saw a 9.2% increase in SaaS and license revenue. On the other hand, hardware and other revenue declined by 0.9%, with the intersegment Other and intersegment Alarm.com segments contributing to this decline. The allowance for credit losses also increased from $950 in 2024 to $2,155 in 2025, indicating a potential risk of bad debt. However, the allowance for product returns remained relatively stable, increasing by only $184 year-over-year. In summary, the primary drivers of revenue growth or decline can be attributed to the performance of SaaS and license revenue, as well as the impact of intersegment transactions on hardware and other revenue. The net income of a company underwent significant changes between 2023 and 2025. Initially, it increased by $378.3 million from 2023 to 2024 due to proceeds from the issuance of 2029 notes. However, this increase was short-lived, as the net income decreased by $401.4 million from 2024 to 2025 due to the absence of these proceeds in 2025. Despite this decline, the net income still managed to increase by $9,115 from 2024 to 2025. The profit margins also experienced fluctuations during this period. The non-GAAP adjusted EBITDA margin increased by $28,738 and then by $29,756 from 2023 to 2024 and 2024 to 2025, respectively. However, the operating margin decreased from 14% in 2023 to 12.8% in 2024, but then increased to 13.2% in 2025. The net income margin showed a more consistent trend, increasing from 9.1% in 2023 to 13% in 2024, and remaining the same at 13% in 2025. The changes in net income and profit margins can be attributed to various factors, including the issuance of 2029 notes and their impact on the company's financials. The discrepancies and inconsistencies in the extracted summaries highlight the need for careful analysis and consideration of these factors when interpreting the data. The company's ability to generate positive operating cash flow is a mixed bag. On one hand, there are instances where the company has successfully generated positive operating cash flow, such as in 2025 and 2023. In these years, the company was able to generate sufficient cash from its operations to finance its activities. However, this is not a consistent trend. There are also periods where the company's operating cash flow is negative or uncertain. The uncertainty surrounding the company's ability to generate positive operating cash flow can be attributed to various factors that affect its operations. Despite these fluctuations, it appears that the company generates positive operating cash flow in some years, but not consistently. This suggests that while the company has the potential to generate positive cash flow from its operations, it is not a reliable or sustainable trend. The company's debt level has undergone significant changes over the past few years. Initially, it issued $500 million 2026 notes and $500 million 2029 notes, followed by an issuance of $485.2 million in new debt, 2029 notes. The total debt increased significantly from previous periods, with a notable decrease in non-current convertible senior notes. However, the current portion of these notes saw a substantial increase. In terms of interest expenses, there has been a significant change. Interest expense decreased by 33% from $11,426 in 2024 to -$17,294 in 2025. This is a notable shift, as interest expenses have increased in previous years. The company's operating income/loss also saw a decrease of $8,180, while interest expense increased by $17,294. Segments that performed well include residential and commercial services, international markets, partnerships with service providers and their technicians, ADT LLC, intelligent automation market, HVAC, property management, network operator, and insurance markets. These segments saw significant growth and contributed to the company's revenue. On the other hand, some segments require improvement. Traditional security customers need to be upgraded to connected solutions, while Ukraine, Middle East, and surrounding areas are negatively impacted by ongoing conflicts. Vietnam, Thailand, and Taiwan may also be affected by tariffs on hardware imports from these countries. The cloud-based technology services segment is potentially impacted by trade barriers or tariffs imposed by other countries. The ADT segment performed poorly due to the loss of this customer, which could harm operating results. Non-hosted software platform revenue is heavily dependent on ADT and may not reach historical levels. Service provider partners also pose a risk if they switch to offer competing companies' point products. International markets outside of North America accounted for only 5–6% of total revenue in the years ended December 31, 2024 and 2023, respectively. Overall, while some segments performed well, others require improvement or have potential risks associated with them. The company has made several strategic moves through acquisitions and divestitures to shape its business landscape. In terms of acquisitions, the company has purchased significant stakes in various entities. Notably, it acquired a 20.3% stake in Pronet for $30.1 million and a 100% stake in RGS for $77.2 million, including an additional working capital adjustment of $1.6 million. The company also made acquisitions in the energy sector, purchasing EnergyHub in 2013. Furthermore, it acquired CEKT and BTR in 2025, although specific details about these transactions are not provided. These acquisitions suggest a focus on expanding its presence in the energy market. On the other hand, the company has also engaged in divestitures to optimize its portfolio. One notable example is the sale of $500 million worth of 2026 notes, which was fully settled on January 14, 2026. This move indicates that the company is actively managing its financial obligations and liabilities to maintain a healthy balance sheet. Overall, these acquisitions and divestitures demonstrate the company's strategic efforts to adapt to changing market conditions and optimize its business operations. The company's financial strategy has been focused on share buybacks rather than dividend payments. As stated in the company's documents, a stock repurchase program was authorized in December 2020 to purchase up to $100 million worth of common stock. This initiative is part of a larger history of buying back shares through various programs, as noted on page 137. The total number of shares repurchased stands at 2,077,480, indicating the company's commitment to this strategy. That concludes the financial summary for Alarm.com Holdings Inc. Feel free to comment below, and I will be happy to answer them when possible.